Okay, let's jump right into this explainer. If you've been following along with our Cash and Treasury Management course, you know we just wrapped up Module 5, which was all about cash forecasting and working capital. Now, that was all about looking ahead, right? Predicting what the company's going to need. But today, we're pivoting. We are heading into the high-pressure reality check of the accounting cycle, Module 6, the month-end cash close. This is where absolutely everything comes together, and honestly, if you're a junior accountant, this is really where you prove your mettle.
So notice the shift in our mindset today. While your daily forecasting work feeds the future cash picture, like you see there on the left, month-end essentially freezes time. It's this critical backward-looking process where reconciliations, journal entries, and reviews all have to happen in a perfect, tightly controlled sequence before the company's books can officially close. The entire company is basically waiting on these numbers to produce accurate financial statements, so getting this right is absolutely crucial.
Here's our exact roadmap to get to a perfect close. We'll look at the 5-day clock, the bank rec foundation, 5 common journal entries, approvals and controls, and finally, common close traps.
Okay, Section 1. Let's talk about the 5-day clock. Listen, you have a strict target of exactly 5 business days. That's it. Within those 5 days, all bank reconciliations must be completely finished and formally approved. This isn't just a friendly suggestion, it is a vital controlled deadline to make sure our financial reporting stays entirely on track. So here's how you actually pace your week. Days 1 and 2, that's your gathering phase. You're pulling statements, starting the recs. Days 2 and 3, that's when it gets a little messy. This is where you roll up your sleeves to research outstanding checks and unrecorded items. By day 3, you are posting your journal entries. Then, days 3 through 5 are all about getting those supervisor sign-offs, comparing your final balances, and filing your checklist. It's all about turning a chaotic pile of bank data into a finalized, approved cash balance by day 5.
Moving on to Section 2, the Bank Rec Foundation.
Now, this represents an absolutely non-negotiable policy. Read it carefully with me. No cash account can be closed for the month until its bank reconciliation is complete and approved, period. The whole shebang starts right here. If your reconciliation shows an unresolved difference, I mean literally, even just a few dollars, you have to find it and explain it before you can ever close those books.
But what does complete actually mean in the real world? Well, to call a rec complete, you've got to check every single one of these boxes. Your adjusted bank balance has to equal your adjusted book balance. You must review all outstanding checks, explicitly flagging anything over 90 days old. You have to verify that your deposits in transit are actually valid timing items and not just missing money. All your journal entries need to be identified and approved, and finally, a supervisor has to sign off. If even one of these is missing, your rec is simply not complete.
All right, Section 3. Let's dig into the 5 common journal entries.
The first 2 are super straightforward, just handling basic bank activity. When the bank deducts a service fee, you debit bank service charges and credit cash. Conversely, when they credit your account with interest, you debit cash and credit interest income. Simple, right? But they absolutely must be booked to get your adjusted book balance to match the bank.
Next up is the NSF check, or non-sufficient funds. This is what happens when a customer pays you, you record it as collected cash, but then a few days later, the bank taps you on the shoulder and says the check bounced because the customer didn't actually have the funds.
So, the crucial thing here is how you handle it. You got to reverse that payment. You debit accounts receivable to put the balance right back on the customer's account, and you credit cash to remove the money you didn't actually get. And here's the real world so what for you. You must notify collections. If you don't book this entry properly, your collections team has literally no idea the customer still owes us that money.
Entry number 4 is the stale check void. If you wrote a check to a vendor and it's just been sitting there outstanding for over 90 days, it's generally considered stale. You can't just leave it dangling on your reconciliation forever. You must void it. That means you debit cash to put the money back on your books, and you credit accounts payable to reestablish that liability. Or, if the obligation is legally expired, you might credit other income.
Finally, our 5th common entry is a reclassification. Sometimes regular operating cash becomes legally restricted during the month, maybe because of a loan covenant or some specific project requirement. When that happens, you have to record a reclassification entry. You debit restricted cash and credit your general operating cash, effectively moving it out of your available funds on the balance sheet.
Okay, Section 4, Approvals and Controls. Let's look at segregation of duties for a second. As a junior or staff accountant, you don't actually have the authority to move cash around,
But you are the one preparing those bank recs and drafting the journal entries. But here's the catch. You cannot approve your own work. A controller or an account manager has to be the one to approve it. And for that final month-end cash balance sign-off, that goes all the way up to the controller or CFO. And let me be super clear here. The reviewer isn't just mindlessly rubber stamping a document. They are systematically executing these 5 specific review procedures. They're confirming the bank recs are entirely complete. They are making sure no entries were self-approved. They'll compare the total cash balance to the prior month to make sure any massive swings actually make sense. They verify that unapplied cash is cleared completely to zero, or at least fully explained. And they scrutinize that outstanding checklist to ensure you caught those stale checks.
Section 5. Avoiding common close traps.
Picture this scenario. It's day 5. It's late in the afternoon. The controller is sweating because the executive team is asking for the initial financials. Your bank rec is off by a few $100s, and you just can't figure out why. Your manager looks at you and says, "Look, just close it. We'll figure it out next month."
You guys, this is the biggest trap of all, and you must respectfully push back on that pressure. Never ever mark the cash close as complete if the reconciliation doesn't balance. Forcing a close hides unexplained differences. That few $100s? It could be a symptom of a much larger error, a totally broken system process, or even missing funds. Just close it is simply not an acceptable accounting policy.
Another massive trap is simply missing the NSF reversal. When you're rushing around on day 3 trying to book all your entries, a bounced check is incredibly easy to overlook because it really just looks like a standard deduction on the bank statement. But skipping this means you effectively give the customer a free pass on their debt, and you are costing the company real money.
And finally, we have the documentation trap. You did the work, the rec balances perfectly, the entries are posted, but you forget to get the physical or digital signatures from your reviewer. Remember the dual sign-off rule. If a bank reconciliation lacks both the preparer and the reviewer's signatures, it doesn't matter how flawless your math is, it is an automatic control failure in the eyes of an auditor. An undocumented close is a failed close.
So, we've seen just how tight this 5-day pressure cooker really is. And we've walked through the highly structured steps required to survive it. But it leaves us with a pretty provocative question. What actually happens when people decide these rules are just too much work? What happens when a team skips the dual sign-off, ignores those stale checks, or deliberately bypasses these strict month-end controls?
Well, we are going to answer that exact question in our next explainer on common fraud and control risks. We'll show you the darker side of accounting, what really goes wrong when controls fail, and exactly why getting this month-end sequence right is the company's absolute best defense. Thanks for joining me for this one, and I'll see you in Module 7.